All right, welcome back to the Deep Dive. Today we're diving deep into something I know a lot of you have been asking about, the wild world of Fannie Mae and Freddie Mac, specifically their conservatorship. We've got a whole bunch of research reports here, some legal analysis, even a few firsthand accounts. Should be pretty interesting.
It's a pretty wild story, that's for sure. From, dominating the market to needing a government bailout, and now this long, uncertain road to maybe possibly exiting conservatorship really shows you how volatile the housing market can be and what it all means for investors.
Yeah, no kidding. So, to kick things off, can you take us back a bit? Like, what did Fannie and Freddie's world look like, before 2008 when everything went south?
All right, so imagine this. By 2008, they were backing something like $5.2 trillion in mortgages, basically half the entire U.S. housing market. Their stock prices were going through the roof. Investors were just throwing money at them. On the surface, it seemed like anyone could achieve the American dream of owning a home. But, and this is a big but, there were some cracks starting to show. Cracks, huh? Like what? Were they just growing too fast?
It was a bit more than that. They were super leveraged, using borrowed money, a lot of it unsecured bonds and those complex mortgage-backed securities to grow really, really quickly. And to make matters worse, they started messing around with riskier loan products, things like subprime and Alt-A mortgages. Those loans given to borrowers with not so great credit or less documentation, usually at higher interest rates.
So they were chasing bigger profits, even though they knew these loans were riskier. Or was there something else going on?
Well, it's complicated. I mean, yeah, the promise of more money was definitely a factor. But it was also a time when everyone was all about deregulation, right? So there were these loopholes they could exploit. And honestly, everyone thought housing prices would just keep going up forever. That bubble mentality, it kind of blinded a lot of people to the danger.
And here's the real kicker. They weren't just any financial institution. They had this implicit guarantee from the government, right? The whole moral hazard thing. Can you break that down for our listeners?
Yeah. Moral hazard, it's basically when someone takes a bigger risk because they know someone else will have to deal with the consequences if things go bad. In this case, Fannie and Freddie knew if they screwed up, the government would probably step in to stop the housing market from completely imploding. So they felt a little too comfortable taking risks they might not have taken otherwise.
So they were playing with fire, using taxpayer dollars as their safety net. And we all know how that turned out. Can you walk us through what happened when those risky bets blew up?
So the bubble finally burst, right? Housing prices, which had been climbing steadily for years, started plummeting. Borrowers, especially those with subprime and Alt-A loans, started defaulting left and right. And we even saw a bunch of strategic defaults, people just walking away from their mortgages. This was especially common in states with non-recourse laws where you could just bail on your mortgage without any real consequences.
So it was like a domino effect.
Yeah.
Bubble bursts, defaults skyrocket, and suddenly these giants are in free fall.
Exactly. Investors panicked and started pulling out their money. Fannie and Freddie, up to their necks in leverage and facing massive losses, were on the verge of collapse. Their stock, which had been trading at like $70 a share, crashed down to pennies. It was a financial earthquake, and honestly, it could have taken down the whole U.S. economy.
And that's when the government stepped in, right? 2008, massive bailout, $187.5 billion.
Yeah.
What exactly did that bailout look like, and what did it mean for Fannie and Freddie?
Yeah, that's when things got really interesting. The government basically took control, put Fannie and Freddie under conservatorship. They pumped in that $187.5 billion in exchange for these things called senior preferred stock purchase agreements, or PSPAs.
PSPAs, those sound kind of complicated. What are those all about?
Think of it like a specialized loan. They gave the Treasury preferred stock in Fannie and Freddie and a 10% dividend on that investment. Plus, they got warrants giving them the right to buy up to 79.9% of the common stock in each company.
Sounds like the government was basically getting first dibs on any future profits. Meanwhile, the original shareholders got pushed aside. What a deal.
Well, yeah, it was a lifeline for Fannie and Freddie, stopped them from completely going under, but it came at a cost. They lost their independence and were stuck under government control, facing a very long and very uncertain road to recovery.
So basically, they were in financial ICU, hooked up to a government-funded life support machine. What did that actually look like? Were they just kind of sitting around waiting to get better?
Well, not exactly. I mean, it wasn't a death sentence, but it wasn't exactly a picnic either. Imagine running a company that's still making money, even billions in profit, but every single major decision you make has to be approved by the government. That was Fannie and Freddie's reality.
What about the investors, the ones who own common stock? How did they fare during all of this?
Let's just say they weren't celebrating. For a long time, their shares were practically worthless. No dividends either. Remember those PSPAs we talked about? The Treasury got priority when it came to profits.
Man, that sounds rough. Especially considering that by 2025, Fannie and Freddie had paid back over $303 billion to the Treasury. That's more than the original bailout.
But there's a catch. That $303 billion wasn't paying back the principal. It was basically just a return on investment for the Treasury. Those PSPAs, they were still in place, and that 10% dividend, that kept on ticking.
So even though they paid back more than they borrowed, they were still on the hook.
Yeah, pretty much. And get this, to make things even more complicated, in 2019, a policy change allowed Fannie and Freddie to keep some of their earnings to build capital. Sounds like a good thing, right? Step towards independence. But it actually increased the value of the Treasury's stake. Remember, they held those senior preferred shares. So as the companies became more valuable, their claim grew too.
Hold on. So the more money Fannie and Freddie make, the more the government's stake increases. Doesn't sound like a very good position for investors to be in.
You got it. And that's one of the biggest things creating all this uncertainty for investors right now. Will they ever see a return? Will the government ever let go? These are the million-dollar questions.
Okay, so let's talk about those exit strategies. How do they actually get out of this conservatorship mess?
Well, there are two main ways: administrative and legislative. Administrative is faster, doesn't involve Congress. It's all about the executive branch doing stuff like changing the PSPAs or tweaking capital requirements.
And who usually prefers that faster approach?
Historically, administrations who are all about smaller government and less regulation, they usually lean towards the administrative route.
Makes sense. So what about the legislative path? What's that all about?
That's where Congress gets involved. They write new laws to reform the whole housing finance system. It's a way slower process and a lot more complicated. Needs bipartisan agreement, which is, not always easy, especially when it comes to something as politically charged as Fannie and Freddie.
So it's a trade-off, right?
Yeah.
Speed versus doing a thorough job. Is one way inherently better than the other?
That's a tough one. Depends who you ask and what they care about. The administrative route is quicker, could get Fannie and Freddie out of conservatorship sooner, but some people say it doesn't address the root of the problem, They say it needs more long-term structural reform to stop this from happening again.
Okay, so what about the legislative path? What are the pros there?
Well, taking the legislative route means they can really examine the entire housing finance system, could lead to some more sustainable and comprehensive reforms. The problem is it takes forever, and getting everyone on board in such a divided political climate, it's tough.
Sounds like a real dilemma.
Mm-hmm.
So what are some of the things that will influence which path they take?
One big factor is the political climate. Different administrations have different ideas about what the government should and shouldn't be doing in the housing market. We've seen that play out already.
So an administration that wants to shrink the government, they'd probably push for that fast administrative exit, even if it means skipping some long-term reforms.
Right. But if an administration is all about bigger housing goals and protecting consumers, they might want to go the slower, more deliberate legislative route.
And what about Fannie and Freddie themselves? Does their financial health factor into all of this?
Oh, yeah, for sure. The GSEs have been raking in the cash for years, exceeding expectations, billions in earnings. That strong financial performance gives them a pretty good argument for a faster exit. It shows they can operate on their own without risking the whole system.
So they're using their profitability to try to get out on their own terms.
Exactly. But there's another big piece of the puzzle: capital requirements.
Capital requirements, what role do those play?
Well, capital requirements determine how much money Fannie and Freddie need to have on hand to cover potential losses. Think of it like a rainy day fund. The stricter those requirements, the longer it'll take them to build up enough capital to actually exit conservatorship.
So those requirements could be a major roadblock to a quick exit.
You got it. Back in 2020, they put in place this super strict capital rule, basically saying the GSEs need to hold about 4% of their assets in capital. That adds up to a whole lot of money, like $283 billion combined.
Wow, that's a huge hurdle, especially since by 2025, they only had something like $81 billion in retained earnings. So who gets to decide on these capital requirements?
The FHFA, the Federal Housing Finance Agency, they're the ones who set the rules. And the director of the FHFA, appointed by the president. So yeah, politics definitely play a role in these decisions.
So a change in administration could mean a change in capital requirements, which could speed up or slow down the whole exit thing.
Exactly. A new FHFA director could come in with a totally different perspective and decide, hey, let's relax these rules a bit. They could bring that required capital down to something more manageable, maybe 150 to 200 billion. That would make a huge difference in the timeline.
So everyone's kind of watching and waiting to see which way the political winds blow and how that affects things. But besides the administrative and legislative routes, are there any other options, other strategies that could change the timing or how this exit goes down?
There's this interesting thing called a consent decree. It's a legal agreement between the government and Fannie and Freddie that could set the stage for a phased exit.
A phased exit, what's that?
Basically, it would let the GSEs exit conservatorship without having all of the required capital. Maybe they only need 50% of the target amount. They'd still be under some FHFA oversight, but they'd get more freedom to operate.
So like a halfway house,
Yeah.
not completely free, but not totally under government control either.
Exactly. And a consent decree has some advantages. First, it would make things happen a lot faster, could shave years off the process. Second, it would signal to the market that the government is serious about letting go. Could boost investor confidence.
So it's like dipping their toes in the water. See how they do with a little bit of freedom, but still have that safety net just in case.
Right. Previous administrations have considered this strategy, and it could definitely come up again as a real possibility.
This is getting pretty complicated. Anything else investors should know as they try to navigate this whole situation?
One thing to remember is that Fannie and Freddie, even though people usually talk about them together, they're actually different. They have their own individual characteristics.
They're not exactly identical twins, even though they're in the same industry and went through conservatorship together.
Nope. They have different capital positions. They've been involved in different legal battles, and they each have their own strengths and weaknesses.
Can you give us some examples of how they're different?
Well, right now, Fannie Mae has more capital than Freddie Mac. They're closer to meeting those capital requirements we talked about. So theoretically, they could exit conservatorship sooner.
So even though they've been on this journey together for so long, their paths to independence might end up looking different.
Exactly. Just another thing for investors to consider.
All right, so we've covered their fall from grace, the long road through conservatorship, and all the possible ways they could get out. Now, the big question, what does all of this mean for investors today? Is this a once-in-a-lifetime opportunity, a trap to avoid, or somewhere in between?
It's a tough one for sure, and I know it's something a lot of our listeners are trying to wrap their heads around. You see those stock prices basically at rock bottom, and you think, okay, this has got to be a good deal, right? But like we've been talking about, there's a lot going on here, a lot of risks to think about.
Yeah, it's definitely not a simple situation. On the one hand, there's the potential to make a lot of money, like a lot. If Fannie and Freddie get out of conservatorship, get privatized successfully, those stock prices could go way up. We could be talking 2.5 times your initial investment, maybe even more. Depends how it all shakes out.
So the upside, it's huge. But what about the other side of that coin? What are the risks investors need to be thinking about? The biggest one is that conservatorship just keeps dragging on. You know, you put your money in, hoping for things to turn around quickly, but they're stuck under government control for years, maybe even decades.
Oof, that would be a rough scenario. Anything else investors should be worried about?
Yeah. There's also the risk that when they do finally exit conservatorship, it happens in a way that screws over the common shareholders. Like they could lose everything or their ownership could get seriously diluted.
So it's a gamble, a big one. High risk, high reward. You could win big, but you could also lose it all. What advice would you give to someone who's thinking about investing in Fannie and Freddie?
First thing, treat this as a high-risk investment. Don't go all in, okay? Only use a small part of your portfolio for these stocks. Money you're okay with losing if things go south.
Diversification is key. Don't put all your eggs in one basket. Got it. Anything else?
Choosing the right account is super important too. Are you using a Roth IRA, a traditional IRA, a taxable brokerage account? They each have different tax implications, different rules about taking money out, and what happens if you lose money.
Can you break those down a little? Which one's the best for this kind of investment? I bet a lot of our listeners are wondering about that.
Sure. Let's start with the Roth IRA. You get tax-free growth, and you can withdraw your money tax-free in retirement. That's a huge plus if those Fannie and Freddie stocks really take off. But the catch is, You can't claim losses in a Roth IRA, so if things go bad, you're kind of stuck.
So Roth IRA could mean big wins, but it could also mean bigger losses. Okay, what about traditional IRAs?
With those, your growth is tax deferred, so you don't pay taxes until you take the money out in retirement. Makes sense for long-term investments, but watch out for those early withdrawal penalties if you need that money before you retire.
And lastly, taxable brokerage accounts. What do people need to know about those?
Simple. You pay taxes on whatever you gain. So if those Fannie and Freddie stocks skyrocket, the government's going to want their share. But you can also claim losses on your taxes, which can help offset other gains.
So the best account really depends on your individual situation, how much risk you're comfortable with, and what you're trying to achieve financially in the long run.
Exactly. And no matter which account you go with, don't get carried away. Don't invest more than you can afford to lose. This is a long game, remember that. Patience is key.
So before we wrap up, I want to touch on something we haven't talked about yet, the preferred shares. We've mostly been focused on the common stock, but I know some people are curious about those preferreds. Can you give us a little rundown on those?
Yeah, sure. Preferred shares, they're kind of interesting, a bit of a hybrid. They offer some of the upside of common stock, but with a little more security. If things go really bad and the company has to liquidate, preferred shareholders get paid before common shareholders.
So like a mix between stocks and bonds.
Kind of, yeah. They usually come with a fixed dividend, good for investors who want some regular income. And if the companies do well, those preferred shares could go up in value too. But they also come with some risks.
Such as? What are some downsides of going the preferred shares route?
Well, the potential gains might not be as high as common stock. And there's no guarantee you'll get that dividend. The company can suspend it, especially if they're struggling financially, like, during conservatorship.
So they're not a sure thing. No guaranteed way to make bank off the Fannie and Freddie situation.
Exactly. Everything comes with risk. Preferred shares are no different.
Well, I think we've covered a lot today. We went through the history, the whole conservatorship mess, how they might get out of it, and what it all means for people who want to invest.
Yeah, it's been an interesting conversation, and I think it shows just how complicated things can be when you're talking about finance, politics, and the housing market. It affects everyone.
For sure. So as we wrap up this deep dive, what are some key things you hope our listeners will take away from all of this?
I think the biggest takeaway is that the financial world, it's rarely black and white. There are always a ton of things to consider, risks to assess, and things can change when you least expect it.
So do your homework. Don't jump in without knowing what you're getting into. Take your time, figure out all the little details, the potential problems, and the things that could change the whole game.
Exactly. And remember, the Fannie and Freddie story isn't over yet. There are still a lot of questions, a lot of twists and turns to come.
So stay tuned. We'll keep you updated and help you navigate all of this as it unfolds.
And as you keep exploring the world of investing, remember to stay curious, stay informed, and don't be afraid to ask questions. That's the best way to understand this complicated financial world and make smart decisions that help you reach your goals.
Well said. Thanks for joining us for this deep dive into Fannie and Freddie. We'll be back soon with another exciting topic to explore. Until then, keep learning, keep asking questions, and keep diving deep.